liquidity providers are predicting this to be the last cartel defense line before silver mirrors gold's all-time physically driven highs.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault from the entire Live from the Vault team. You know, Live from the Vault is the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. With exclusive access to experts and insiders, we reveal information and insights that you simply won't find anywhere else. Hi, my name is Shane Moran, and as you can see, I'm back in the vault, and I'll be your host for this week's episode, and we'll be joined very shortly here by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of gold and silver and expose what's really going on in the precious metals industry. So get ready for another blockbuster episode of Live from the Vault, and we'll bring you knowledge and the understanding that the mainstream media just will not provide. So before we get over to Andrew, I just want to make sure that you can help the show out by hitting that subscribe button and the bell notification right there if you want to be notified in real time as each episode goes live. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, can we start off by picking up the thread from our last episode we recorded on March the 6th, only 2 weeks ago, and you predicted that silver commenced a very large, 1.66 rally from $24 right up to $25.66. Can you bring us up to date on what we should expect now moving forward?
Yes, Shane, and it's great to be with everyone again, of course, and it is a good place to start. So let's start by connecting the dots from our last market episode. Can't believe it, 2 weeks ago, where we did a deep dive into the silver cartel and how the silver cartel operates, so as to really better question why was it that with gold rising into all-time record highs in fact, 2,300, silver was lagging so far below its all-time $50 2011 highs. That was kind of why we did a deep dive. And really, to kind of sum up, with gold breaking out of its 2024 officially capped range, and we talked about why this is official last time, joined at the hip silver had become the focus of an officially sanctioned PSYOP operation to weigh on gold sentiment. That has been the case for many years. However, while this effort succeeded in tricking out the speculative hot money, that is the CTAs who fractionally own these 96% leveraged undeliverable gold, COMEX gold positions, so they only need to put up 4% to control these big positions. Also, we saw them concurrently ditching their long gold ETF positions, the exchange traded fund positions. We've done episodes about the ETFs, which is really the illusionary ETFs, because we know, and there's more evidence, we'll look at that, there's some evidence in a minute, as to why these are not one-to-one back positions. Now, what happened was officials, through all of this, they failed to account for a huge upsurge in fully paid up, unleveraged, foreign central bank physical gold buying. Now, taking advantage of the paper market analysts misreading the outflows of the gold ETFs as weakness, which they were verbatim doing, these foreign central banks simultaneously pulled the trigger on a massive, we talked about it before, net stable funding compliant spot gold physical buying operation. Net stable funding meaning that ratio means that it's basically in the over-the-counter markets in London and globally, they have to be physically backed, unlike the COMEX, which isn't compliant. So what was happening is, because so much of the focus is on the COMEX, under the radar, it also had set silver up for the commencement of the current coiling breakout rally that we were talking about last time. So in a nutshell, what has happened since our last episode is exactly what we're talking about. Now, I'm going to pick up the gold thread shortly because there are notable signs of insider stress to cap the current rally. And we've seen evidence of them trying to do that. But to assess what to expect going forward, let's first close the loop on the silver story, which, as we recorded on the 6th of March, which was our last episode, was trading at $24, telegraphing silver was imminently coiling for the first leg of a physically driven structural supply-demand imbalance, which we had not witnessed since the March 2020 COVID refinery shutdowns. And that had driven, and the chart will show you that, that this drove an $18 rally from $12 over the next 5 months with almost very few pullbacks until it knocked on the door of $30. Now, and so obviously, here's what you can see on this link. As we'd observed, this coiling trigger for silver to imminently break out of the current capped 2024 range, we saw it being capped right from the beginning of January, it was being driven by the relentless, joined at the hip, central bank-driven gold rally. Basically, with COMEX silver open interest, i.e. the chips in the casino, having contracted from 38,000 tons back in March 2020, which is when we're talking about the rally commencing, to around, in that rally, we saw about 15,500 tons ditched. I mean, so that's arriving at 15,500 tons. So Richie, basically, that's ditching a massive 22,500 tons of synthetic silver warrants that were previously able to be just batted around between the cartel insiders and the CTA herd, who the hot money who could be relied on to never take a single ounce of delivery. What it does do is now evidences paper market liquidity to game silver lower. It's still just about enough to target the speculative traders' stops, which is what we're seeing, little bits shallower moves. But it's running too thin to add enough paper silver supply to ultimately stop silver breaking out to its all-time highs and beyond. I mean, okay, short term, we're going to see intraday gaming around events such as FOMC today. We're going to see that today, that we're recording this on Wednesday. It'll be out in about 3 hours from now. But there are reasons that this rally will simply endure. And as we reported last time, a deliberately starved for supply physical market had evidenced liquidity providers who were sanctioned to source silver turning their attention to the COMEX Achilles heel. Each of these buyers taking the maximum allowable 3,000 lots of COMEX open interest, which is 466 tons apiece, and to physically load out the only source of spot-priced wholesale silver bars out of the New York COMEX vaults. And as we'll explain later, the 900 odd tons of deliveries of SLV deliveries so far do not include the pending for delivery contracts, which the cartel can drag their feet delivering until the end of the month delivery deadline. So to recap, we've seen about 900 tons of deliveries out of the COMEX, but you're not yet seeing what they can delay delivering. Because this is where it gets really interesting. So in an attempt to get down and dirty, the cartel resorted to its old tricks, borrowing silver from the SLV ETF, in other words, the Silver Exchange Traded Fund. And as we know, the SLV is exchangeable, much like gold, is exchangeable with COMEX open interest, and with registered COMEX inventories insufficient to make good on a sudden surge of delivery demands, so as to escape defaulting on delivery of these unexpected bullion drains, SLV stock was borrowed. But so large was the demand for COMEX silver that by non-farm payrolls, which was the Friday after we did the episode on the 8th, the cost to borrow SLV short shares exploded, as you can see here, to unsustainable extremes, forcing the cartel to begin folding a very wrong-footed silver shorthand, driving the silver price higher by a full $1 per ounce. Now, insiders have managed to shake out some hot money into subsequent news game beats, and which is always the case. I mean, a little bit of uncertainty, and these guys are so fickle, of course, and they know where the stops are. They can move, they can rinse them out. So we can see that since then, the cost to borrow has contracted a little. None of this very costly delivery stress has gone unnoticed. And I want to bring this to your attention too, as after a little healthy consolidation, it shows the cartel is vulnerable to an upcoming, much larger, physically driven short squeeze. Now, to provide context, the average cost to borrow SLV shorts has always ranged somewhere around about 42 basis points, 0.42%. And it closed on the 7th, at 0.413%. So when the cost to borrow exploded higher on the very next session to 0.766%, it's a massive, massive spike, exceeding actually the borrowing costs when silver traded in the 26s 12 months ago. It telegraphed a higher silver price was coming. Now, these rising borrowing costs forced insiders on the hook for these shorts, which liquidity providers actually assess had aggregated break-even of about $21.50 silver. We were into the 25s. It left a deep hole from which to begin buying back these naked short bets to cover off an untenable wrong-footed silver short position, which is why the cost to cover spiked. Now, let's not forget, this entire situation was caused by, and is actually blowing back, against the LBMA cartel as a direct result of their refusal to supply what ultimately grew to pretty close to 2,500 tons of spot-priced Indian silver orders that had begun to accrue unfilled at global refineries 4 weeks ago. We made a huge deal of this. And as we highlighted in our last episode, this placed the COMEX in the crosshairs for physical delivery, hence us drawing public attention to it in our last episode. Now, under pressure to deliver COMEX silver, insiders threw in the towel directly after the chart-painted Thursday COT cutoff, which was on the 12th, which is the day when all the contracts are basically reported. And we all know this report comes through and it's delayed by 3 days, which is ludicrous because the information's there. But anyway, you can see that they threw in the towel right on that cutoff, at exactly that cutoff on the 12th, allowing the spot FX silver price to rise over $1.40 per ounce in spot terms, from $24 to $25,430, which is actually the COMEX delivery terms. That was up by, if you think about it, $8,300 per COMEX contract. So that was the cost that it was going to cost you to actually buy these things back. You're deep in the hole. However, it is the COMEX targeted New York Vault silver bar loadouts that have depleted registered COMEX stocks, which is what forced SLV to be tapped for supply. But this effort was barely sufficient to offset the deleveraging of what is 93% unbacked COMEX paper warrants to meet an increasing number of silver buyers targeting the COMEX as the only available left source of silver for physical delivery, because they were starved for supply. This is a blowback. And while these insiders' short covering efforts had by Friday driven silver into the 25.66 level, which was the ultimate high, which is the high that we made last week, but is yet to be taken out. It kind of relieved some of the imbalance, but there's still an overhang of COMEX buyers waiting for delivery, albeit dragged out until the end of the month delivery deadline.
Hey, Andrew, is the silver demand still evident right now?
Yes, Shane. Although Chinese silver demand is strong too, their efforts are really largely conducted in alliance with the LBMA professional trade, the cartel, which suits them as industrial buyers as it serves to keep the silver price down. However, what is really driving the current breakout from the cartel's capped ranges is a surge in both retail and commercial Indian demand. So in order to meet India's climate transition goals, one of the primary drivers fueling 2024 silver demand is the Indian government production-linked incentive called the PLI scheme, which has just now fully come on stream in March of this year. This is being led by strong policy support and is growing demand, and there's a growing demand from domestic rural-driven solar power installations. Many of these operations were known months and months ago, and even last year, but have now come online since this March, just as this one here, Reliance Industries, is, as you can see here with this link. Now, these are just some examples of what is driving silver demand. And as is outlined in these reports, India's solar module manufacturing capacity is expected to grow by 60% by 2025. And just as this silver demand comes online, these operations have been caught lacking the necessary silver supply to meet targets. Now, the Indian government incentive scheme requires thousands of tons of fresh silver supply, far exceeding available mine supply, but also competing with very strong Indian retail demand, which has ramped up, driven by the relatively higher cost to buy gold. So you've got a perfect storm here. This is unfactored physical demand. And with COMEX silver open interest now scraping the bottom of the barrel, as it has for the same matches in gold, of course, where gold open interest has roughly halved over the last since 2020. So really, COMEX gold open interest is roughly 2,500 tons, and it catches the greedy paper shuffling cartel extremely wrong-footed. Now, it's the difficulty in getting the silver bullion to meet these deadlines that is causing the offer to sell this bullion to be bilaterally settled at prices well above the rig cartel's silver daily FX fix. We see the fixes coming through at noon every day our time. It's not available at that price. And it's clear that thousands of tons of unfactored silver demand will force the offer price to sell silver significantly higher through 2024. This has only just commenced. So to escape bilaterally settled high premiums, it's just cheaper to take delivery on the COMEX and then ship it out. So bottom line, driven by the cartel's refusal to deliver spot price silver into a backlog of Indian refinery demand, Indian-driven refinery demand, in attempts to meet these imminent supply goals, the COMEX has come into the crosshairs. This is what we're saying for physical delivery. This is something which people are not aware of. And I really want to hammer it home. The attack on the COMEX, back delivery door, literally backing that truck up and taking delivery of what is really not supposed to be delivered. It is pure pay. This is what leverages the paper warrants. What it's done is already driven these exchange-traded fund borrowing costs to extremes, and with only a few hot money weekends still to rinse out, it will deplete sufficient synthetic cartel supply to actually contain the real silver price from emerging. Now, driven by a physically driven rally, it will be impossible for the cartel to hold silver back from catching up to mirroring the joint at the hip all-time gold market highs. And we're very close to this inflection point that will drive a similar to gold physically driven rally in silver. Now, people are asking me the questions, but what kind of, where is that point? Well, it's 20. The futures position is $26.25. So that is the level. That is the all-watched inflection trigger. And given the underlying refinery shortages into really unprecedented strong demand, liquidity providers are predicting this to be the last cartel defense line before silver mirrors gold's all-time physically driven highs. Bearing in mind, it'll take a few months to get there, but that is the last line in the sand. Now, very short term, the SLV ETF continues to evidence heavy outflows of over 200 tons over the last 4 weeks, which is bullish, as in addition to borrowing SLV shares, these outflows are directly related to the commercials, the insiders having to scramble to put together enough silver to meet hundreds of tons of backdoor loadouts. Now, this demand is driven by liquidity providers representing these Indian and Chinese buyers who have been unable to get the bullion from the refiners, starved for spot silver delivery on the London cartel.
All right, with all this silver talk, Andrew, can you tell us what you're seeing in gold?
Yes, Shane. Looking at gold, the still puzzled mainstream media analysts continue to grapple with why is it that the gold ETFs, the shares, and alongside the gold depositories have evidenced such large outflows, yet the gold prices continue to rise to all-time record highs. So last week, we evidenced some hand-holding by the big trading block monoliths such as BlackRock and JP Morgan, acknowledging that gold had been, quote, the go-to hedge for most portfolios. So in other words, these are the sticky CTAs we've been tracking, and notably, and obviously, what was this was also bolstered with was JP Morgan now saying, you know what, we see 2,500 gold as fair value. So it's only just dawning on the mainstream media analysts such as Bloomberg that gold is being driven higher due to massive global central bank physical demand actually coming to it. We've heard the murmurings of that. It's just simply some of the analysts are woken up enough to figure out that that's what it must be. Now, we've covered the main reasons that the CTAs have been dumping their ETF gold, such as rotations out of the gold ETFs into the Bitcoin ETFs. But ironically, their wrong footing has been compounded by these same gold ETF outflows as being wrongly read as bearish. So it's a kind of a self-perpetuating doom loop that is being alchemized by the larger central bank buyers. So with no view through to the oxygen-fueled windowless COMEX casino, it's understandable that the outflows of about 50 tons of this ETF, of the ETFs and depository outflows during the gold price, while the gold price was rising, had baffled them. However, over the last 3 trading sessions, and partly related to what we will look at in a minute, we've evidenced some sizable gold ETF inflows. And as we record this episode today on Wednesday, these outflows have reversed into a 7.6 ton inflow into the all-watch GLD ETF. Well, you kind of wonder what that is. And we've looked at the rising cost to borrow SLV shorts to try and meet the backdoor loadouts of the COMEX silver vaults in London and New York. Now let's look at the similar spike in borrowing costs in the gold ETF, which despite official efforts to rinse out as much non-sticky CTAs to repay increasingly underwater GLD shorts, these costs to borrow have risen to unsustainable levels. Now, last episode, we looked at the differences on how COMEX gold versus silver is being drained. So really, just to put that into context, to sum that up, the difference is that while the non-Basel III compliant COMEX gold targets the first tier Basel III compliant exchange for physical backdoor, forcing delivery in London, in London in physical delivery terms, non-compliant silver literally, the buyers are directly targeting the COMEX New York vaults. Yeah, there's more of a cost to shipping it, but the reason they don't target the EFP backdoor is due to the fact it's not NSFR compliant once it lands, and it would simply then feed and the unallocated silver back into the London professional trade's hands, re-enabling this eternal circle. So let's look at the stress evident in the gold ETF, the GLD ETF, which is really a pool of gold bullion that is, as the prospectus says, that it owns only gold bullion and sometimes cash. Their statement, which is ludicrous because what that does is provide the cartel members, custodians, which is HSBC, along with JP Morgan, yes, the very same bank that the Department of Justice called a criminal enterprise, provides them a massive flywheel that is clearly sanctioned by officials to keep a lid on gold, benchmarked against the depreciating dollar. Now, for reference, in plain vanilla form, to keep it simple, each share of GLD is worth 1/10 of an ounce. So as soon as March trading began, gold began the next leg of its strong, physically driven central bank rally. And by no coincidence, the cost to borrow, meaning the cost to short, sell GLD shares, began to rise steeply from just under 40 basis points, 0.4%. And by the time gold had hit its all-time highs at 21.95 spot, that is April futures 2203, the cost to borrow these GLD shares to meet COMEX-centric demand by Monday had spiked, and here is the evidence of it, to 1.06%. This is massive. Now, bearing in mind, these borrowed shares have to ultimately be paid back, which poses the question, who and what would motivate someone to dare to borrow these shares at a price costing them over $23 per ounce, or $2,300 per contract above the highest recorded spot gold price? That is nosebleed levels. And that's where they're borrowing them at. So you've got to pay these back. And so if the price rises even more, you're in an even deeper hole. So the who, though, the who, we know the why, but the who, it has to be the Fed, because no taxpayer funded too big to fail first-tier bank compliance team would allow such a multi-billion-dollar high-risk naked short bet to be made. So the why is the attempt to try and swamp the gold rally by adding borrowed supply in the hope that officials can try and repay these borrowed gold bets at a lower price. And yes, we know that the Fed can print as much cash as they want. But here's why that's still going to backfire. Because it always raises a flag that the Fed's got unlimited funds. But let's face it, the Fed is the only remaining global central bank still now betting against a higher gold price. And they're reduced to employing the only tool left in the toolbox, which is using leveraged paper gold to try and chart paint a top. But every other global central bank is simultaneously swapping their excess dollars for physical gold and are capitalizing on being able to convert these COMEX-centric synthetically derived prices into deliverable NSFR-compliant bullion through the EFP mechanism. So this leaves the Fed constrained to how many paper market CTAs they can suck in to puke up their recent long bets to repay these GLD shares. But even the mainstream media is now waking up to the fact that not only have the COMEX gold stocks available to be traded contracted by half over the last 4 years, as BlackRock and JP Morgan put it last week, gold has been the go-to hedge for most portfolios. So in other words, while COMEX and ETF gold are paper-centric, these are the sticky CTAs we've been tracking ever since Basel III NSFR standards revalued foreign exchange gold as a first-tier asset class. And it saw them increasingly using gold. It started small, and it's been building, and they're increasingly using gold for what it says on the box, which is a real risk hedge, an alternative first-year asset class that trades alongside US Treasuries. And these CTA positions are largely unrinsable. Now, we looked last time at how the deleveraging of 96% COMEX open interest, which is the casino chips, is being forced by the central banks draining these chips through the EFP backdoor, forcing them to be crystallized. Now, on the 1st of March, with spot gold trading at, it was 2,039 per ounce, 14.8 tons of GLD had been short sold. Now, just 6 sessions later, on Friday the 8th, with spot gold trading $156 an ounce higher at 2203, this short position had been cut by 8.5 tons, meaning with a cost to borrow rising from 0.4% to 1.06% as gold hit all-time highs, and 85.5 tons of these bets had to be underwater at a potential at least $150 per ounce. The only possible holder of these deeply underwater bets, which is a $46 million naked short bet, has to be the Fed. This is actually evident in the CFTC published COT reports. We've looked at those in the past. I'm not going to bore you with them. But in summary, while there was a load of hand-wringing in the last report about the growing commercial short position in gold and in silver, but on the other side of these offsetting positions, a great deal of these long CTA additions are actually sticky real market hedges. So interestingly, just as we predicted, we see the Fed beginning to switch tactics, trying to inject volatility into Bitcoin, which has now come in the frame of an unwanted dollar benchmark. So really, it is an alternative to the dollar. Now, we did an episode about this, but it makes sense. Fighting a losing battle against every other central bank seeking a higher gold price to back their respective currencies, and notwithstanding the upcoming alternate BRICS payment systems coming into play, the Fed battle tactics have to change. Do you think it was a coincidence that a so-called rogue trader dumped more than 400 Bitcoins in less than an hour, evidencing an 8% drop, triggering the biggest single-day outflow since January the 11th? Really? You think that was a coincidence? Through the employment of position concentration in the sanctioned Bitcoin ETFs, the PPT, the plunge protection team, who is behind all of the organized selling on behalf of the Fed, they can use concentrated positioning to inject volatility, just as they had for decades with gold, usually in and around news events to target visible stops. So they can, so they can in the Bitcoin ETFs, where they know where the stops are too. So in the process, thereby, they're also injecting volatility into the Bitcoin, which is something the COMEX was formed to do 50 years ago for gold. So this is just another competitor to the dollar. And given that the Fed acknowledges intervening in all the foreign exchange crosses, becomes far more preferable to short and buy back synthetic Bitcoin than selling gold, which is ultimately NSFR compliant and physically deliverable, leaving them in a deeper and deeper hole. Now, it would be far more preferable to print cash to bail out themselves out of a rising Bitcoin. I'm sure they cannot contain the price of Bitcoin, but unless they legislate against it, which is doubtful. But it's far more preferable they can just print this cash. The ability to print cash is just limitless. Rather than trying to deliver physical gold they do not have in the first place. And this is going to competing central banks.
Hey, Andrew, talking about the upcoming BRICS payment systems, can you update us on what you're hearing out there?
Yep. Happy to do so. Now, we understand that Glasniev's closely guarded Russian central bank currency white paper has now received the green light from the top Kremlin advisor, Yuri Ushakov. And following recent beta testing, it will be formally presented to the BRICS 10. That's the May 14th to 19th Kazan summit next month. Now, given the BRICS 10 plus members, control the lion's share of the multi-trillion-dollar oil and energy complex, the scale of this upcoming de-dollarization process cannot be underestimated. And everyone that I hear says, "Oh, don't worry about it. It's not going to happen." Now, we've previously looked at Glasniev's two currency baskets, one which would run concurrently with and competing with the SDR, which will obviously run concurrently but take time to get traction. But more importantly, which is really what most people make the mistake of just focusing on, but more importantly, the second basket is backed by commodities and gold. Now, the clue that the preferred of the two currency baskets and the lion's share will utilize gold and hard commodities, which may include silver, I'm not sure, but it could, is the recent statement by Foreign Minister Sergei Ryabkov that the currency will more effectively use available resources of the countries in mutual settlement to avoid losses due to differences in exchange rates. His words.
Andrew, I got to tell you, man, this has been incredibly educational. I know you've looked at the internal COMEX casino, the mechanisms in the past. I know we've talked about this often, but we've had a lot of questions coming in from our community about how this game is coming apart. And can you give us a current overview of what's happening in the casino?
Yes, Shane. This is actually quite a simple process, and it does illustrate how this paper to physical game is coming apart. Now, the futures market short sellers have historically held the advantage over longs. It all comes to a head into what is called first notice day. This is when everybody in the smoke and mirrors COMEX world have to finally show their hand. Now, a short seller indicates their intention of physically delivering the contracts that they've already sold forward, whereas the longs on the other side of the trade must stump up the full cost. That's 96% more than the 4% they invested, full cost of the contract, indicating they're going to stand for delivery. So, while the long has to stump up the full value right away, the short, which is always a market-making first-year bank, they can drag out fulfilling delivery for up to the remaining 30 days of that month's contract. So really, if you want an example, for the current front month, which is the April contract, first notice will be on the 28th of March. And the longs must pay up, but may not get delivery until the end of April. Now, a legitimate trader would like to square up positions as soon as possible. It's an overhang of risk. But it's been the usual for the cartel insiders to shuffle paper warrants amongst themselves, and with no real physical being delivered, it usually bought time for the cartel members to create a price waterfall, which ultimately disincentivized the longs standing for delivery from ever taking delivery. And what they would do is simply cash out of their obligation to take delivery because it was such a lower price than they'd originally locked it in at. Obviously, this is a simplified, very simplified example, as there could be hedges in place, and it may be that these longs still actually stand for delivery, but the delay provides the short seller, this is the bottom line, it provides the short seller time to source bullion for delivery, usually at a lower price. However, to answer your question, Shane, this is not what we're evidencing now. This is undoubtedly the condition that we're currently evidencing in both the gold and silver ETFs, which is GLD and SLV. Both have evidence insiders clearly called short of available bullion to deliver into COMEX buyers standing for delivery to pay to pay massive premiums. These guys are having to pay massive premiums to borrow ETF stock so as to meet underwater derivative bets. This is not a good situation. Synthetically diluted COMEX gold is being targeted for physical delivery by central banks, using the EFP mechanism, and these outflows completely circumvent the paper shuffling warrant game, as these outflows immediately land in the T+2 regulated Basel III NSFR compliant over-the-counter FX gold delivery markets, meaning that the minute it lands there, the obligation to deliver is in 2 days. And because it's NSFR compliant, within a very small, tiny premium in excess to what they've landed at, because that is the price. And what that's doing is effectively deleveraging and neutralizing the 96% non-compliant paper market stocks. So while these EFP outflows are limited in a session to a single position limit of around 18.6 tons, what we're evidencing now is multiple global central banks are alchemizing this undervalued backdoor opportunity. Well, we all know what the central banks are doing and why. They are fast exchanging their depreciating dollars, euros, yens, pounds, whatever you want, whatever fiat currency you can think of, much like we are. And it's primarily about wealth protection. My only question, though, is how are you doing in this process? How much physical gold and silver do you own?
Absolutely. Thank you, Andrew Maguire, for talking gold. And remember, to our entire Life in the Vault community, buy physical and make sure it's backed 1-to-1, and understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. Now, please help keep spreading the word about this channel by hitting that like button right there. Share this information and subscribe if you haven't already done so. And if you click on that bell right there, we're going to notify you as each episode goes live. And with that, we'll see you next time right here on Live from the Vault. See you then.